Picture two guys, same age, same city, same paycheck. They've both been saving for years. They both finally have $50,000 sitting in their bank accounts. And they both want the same thing, to stop living paycheck to paycheck, to actually build something, to reach the point where money is working for them instead of the other way around. Same starting line, same dream, same $50,000. The only difference is what they do with it. Ryan buys a rental property. Marcus puts his money in index funds. 20 years later, one of them is financially free. The other is tired, stressed, sitting on a house he can't easily sell, and quietly wondering if he made the right call. Here's the part that should scare you. On the day both of them made their decision, they were both completely, absolutely convinced they were right. Ryan had watched real estate videos. Marcus had read about the stock market. Both had talked to people who backed them up. Both walked away feeling smart. And one of them was sitting at the beginning of the most expensive mistake of his financial life. The fight between real estate and stocks is the most common money argument in America. Backyard barbecues, Thanksgiving dinners, work break rooms, everybody has an uncle who swears by rental properties. Everybody has a coworker who won't shut up about index funds. But almost nobody has run the actual, complete, honest numbers all the way to year 20. I did. No sides, no cheerleading, no thumbnail math that makes one option look perfect. Just Ryan, Marcus, 20 years, and the truth that will either confirm what you're already doing or completely change it. Let's go. Both of them walked away feeling smart, and one of them was making the most expensive mistake of his financial life. Ryan closes on a $260,000 three-bedroom house in a clean suburb outside of Dallas. He puts $52,000 down every dollar he saved. His mortgage payment is $1,382 a month at 7% interest. He finds a tenant willing to pay $1,850 per month. Do that math real quick. $1,850 coming in. $1,382 going out. That's $468 a month in profit. Before anything else, Ryan drives past his rental property on the way to work every single morning. He points it out to whoever's in the passenger seat. His dad tells him he's doing it right. His LinkedIn post gets 47 likes and 3 comments from people saying that's the move. Ryan feels like he figured it out. Marcus takes his $50,000 and puts it into a total stock market index fund. No house, no keys, no tenant. He sets up an automatic $300 monthly transfer and gets a confirmation email. His coworkers ask him what he's investing in. He says index funds. They nod politely and change the subject. Nobody's impressed. At the end of year 1, Ryan has a physical asset he can drive past, a tenant paying him monthly, equity building in his name, and a story he tells at every dinner. Marcus has a number on a screen that went up a little, then down a little, then up again. Ryan feels like he's winning by a mile, and for right now, in the feelings department he is. But feelings and math are two completely different things, and the math is just getting started. Marcus has a number on a screen, Ryan has a story he tells at every dinner. The feelings aren't even close, the math is. Let's talk about the number you always see on real estate videos. $468 per month. Passive income, cash flow positive, the landlord life, financial freedom. That number is real. And that number is also the most misleading number in real estate investing because it's the number before reality shows up. And reality shows up fast. Year 1. Ryan's water heater dies. $1,300 to replace. And that's if he finds a decent plumber quickly. Which he doesn't, because it's the week before Christmas. The tenant reports a slow leak under the bathroom sink. Plumber visit, $380. Property taxes in Texas, $3,200 for the year. Not optional, not negotiable. Landlord insurance, $1,600 annually. 1 week of vacancy between a minor tenant situation, $425 in lost rent. Still has to pay the mortgage. Year 2. The tenant leaves after a lease disagreement. Ryan spends 3 weekends showing the property. He repaints and deep cleans $900. He loses 1 full month of rent, $1,800. $2,850. And the mortgage doesn't care that the house is empty. It's due on the first regardless. Year 3, November. The HVAC system starts failing. In Texas in November, you don't wait. Tenants will leave. Emergency repair, $2,200. Now let's add all that up honestly. Over 3 years, Ryan collected $66,600 in gross rent. His mortgage payments totaled $49,752. On paper, that's $16,848 left over. But after property taxes, insurance, repairs, vacancy losses, and the endless weekend hours he spent managing everything himself to save money, his real cash in hand over 3 years is somewhere between $2,500 and $4,000, not $16,848, $2,500 to $4,000 in 3 years. On a $52,000 investment while working a part-time job nobody's paying him for. Meanwhile, Marcus checked his account. His $50,000 plus $10,800 in monthly contributions, growing at roughly 10% annual returns, is sitting at about $78,000. He made 0 phone calls, fixed 0 broken things, lost 0 sleep over an empty house. But, and this matters, Ryan still has something Marcus doesn't. His $260,000 property has appreciated to around $285,000. His equity, the gap between what the house is worth and what he still owes, is now $60,000 to $68,000. Real money. Built partly by using the bank's money, not just his own. That's called leverage. And it's the single biggest weapon in real estate that the stock market simply cannot match. At year 3, both strategies are working, just in completely different ways, and the story is just getting interesting. The mortgage doesn't care that the house is empty. It's due on the 1st, every single month. Year 7, this is where things start to quietly separate in a way that's hard to see unless you know what to look for. Ryan is on his 3rd tenant. He raised rent to $1,975. He replaced the roof 2 years back, $9,200, paid out of pocket because he wasn't keeping a repair reserve like he should have been. A plumbing emergency added another $1,600. 2 more months of vacancy across the years. His property is now worth $315,000 to $330,000. His equity has grown to $120,000 to $135,000. That is genuinely impressive. He turned $52,000 into 6 figures of equity using the bank's money. That's the version of the story Ryan tells at real estate meetups. And it's true. Here's the version he doesn't tell. Over 7 years, Ryan has spent conservatively somewhere between 600 and 800 hours managing this property. Tenant screening, repair calls, lease renewals, driving to Home Depot for parts. One near eviction situation that never went to court but still consumed 3 of his weekends and cost $800 in legal consultation. That's a part-time job, an unpaid one. Marcus? His portfolio. $50,000 initial plus 7 years of $300 monthly contributions at 10% average annual returns is sitting at about $140,000 to $155,000. He worked 0 extra hours, 0 weekends, 0 trips to Home Depot. But here's the number from Marcus's side that should genuinely alarm you. At year 7, Marcus's portfolio is now generating more money in annual compound growth than he's putting in himself each year. Read that again. The money is making more money than he's adding. The machine is running itself. Compound interest is boring for the first 5 years. Then it becomes violent. Ryan is still slightly ahead in total net worth, but the gap between them is closing, and it's closing faster every month. Year 10. Both men stop, look at what they've built, and the scoreboard reads something neither of them expected. Ryan's property, worth $345,000 to $360,000. Remaining mortgage balance, $168,000. His equity, $177,000 to $192,000. On top of the original $52,000 down payment, He spent an additional $28,000 to $38,000 in real out of pocket costs, repairs, vacancy months, capital improvements, taxes, insurance over a decade. Marcus's portfolio $168,000 to $185,000. He put in $50,000 up front and $36,000 in monthly contributions over 10 years. $86,000 total out of his own pocket. Everything else, the other $82,000 to $99,000, grew on its own. At year 10, they are essentially tied. Ryan might be slightly ahead, but let me tell you exactly what that means when you say it plainly. Ryan took on $208,000 in debt. He put his entire financial bet on one house in one zip code. He spent hundreds of personal hours managing it. He lost weekends. He fielded late-night calls from tenants. He dealt with repairs he didn't budget for. He stressed about vacancy months. And he arrives at year 10 in roughly the same financial position as Marcus, who opened a brokerage account, set up an automatic transfer, and never thought about it again. Same destination, completely different journey. That's not a knock on real estate. That's the honest halftime score. And the second half years, 10 through 20, is where this story fully separates. Ryan spent 10 years working for his wealth. Marcus spent 10 years waiting for his. They arrived at the same place. 20 years. Ryan's rental property is now worth $450,000 to $510,000. His mortgage is paid off or within a few payments. His total equity, $430,000 to $510,000, depending on how the Dallas market moved. Over 20 years of collecting rent after every repair, every vacancy month, every property tax bill, every insurance premium, every capital expenditure, his total net cash flow profit above all those costs lands somewhere between $45,000 and $85,000. Add that to his equity. Ryan's total wealth position at year 20, $475,000 to $595,000. Let me say, clearly that is a success story. Ryan turned $52,000 into close to $500,000. That is real. That is legitimate. Don't let anyone tell you otherwise. Now, Marcus, $50,000 starting. $300 per month for 20 years. 10% average annual returns, which is what the U.S. total stock market has historically averaged over long periods. His portfolio at year 20, $420,000 to $465,000. Of that, only $122,000 came from his own pocket over 20 years. The rest, $298,000 to $343,000, is pure compounding. Money that multiplied while Marcus slept, went on vacation, spent time with his family, and never once answered a call about a broken pipe at 11 p.m. At year 20, Ryan and Marcus are in the same ballpark. But now here is the single number that changes this entire conversation. If Marcus had increased his monthly contribution by just $200 from $300 to $500 per month, his 20-year portfolio jumps to $570,000 to $620,000. He passes Ryan without a mortgage, without a single tenant, without a single weekend trip to Home Depot, just by moving $200 more per month into the same account he already had. And here is why that should make every real estate investor pause. If Ryan wants to grow his wealth by a similar amount, he doesn't add $200 to a form. He buys another property, another $50,000 down payment, another mortgage, another tenant, another part-time unpaid job added to his life. Marcus adds $200 to a form. Ryan takes on $260,000 in new debt. That difference, quiet, invisible, and almost never discussed at real estate conferences, is called asymmetry, and it is one of the most important ideas in this entire video. Marcus adds $200 to a form. Ryan takes on $260,000 in new debt. That's the part nobody talks about on stage. I'd be doing you a disservice if I only made one side look bad. So let me be fair, brutally fair to both. Real estate has genuine superpowers that index funds simply cannot replicate. The first one is leverage. Ryan used $52,000 to control a $260,000 asset. Marcus used $50,000 to control $50,000. When property values rise, Ryan's gains are multiplied because he controlled 5 times more asset than he paid for. This is why real estate has created more first-generation millionaires in America than any other asset class. Leverage is a real, powerful, wealth-building tool. The second superpower is depreciation. The IRS lets Ryan deduct the theoretical decline of his building from his taxable income even if the property is actually going up in value. That's a legal tax advantage that stock investors simply don't have. The third is cash flow. Marcus's index fund doesn't mail him a check every month. Ryan's tenant does. In a strong market, that monthly income is real money you can spend right now. That matters especially if you're trying to replace your salary. And there's one strategy called house hacking, where you buy a duplex or small multifamily property, live in one unit, and rent the others that can reduce your own housing costs to near zero while building equity. The stock market cannot do that. Nothing can do that. Now the other side. The things Marcus's fans never want to admit. In 2008, the US stock market dropped 37% in a single year. In March 2020, it dropped 34% in 5 weeks. If Marcus had $150,000 invested and watched it fall to $97,000 on a Tuesday, that is not a number on a screen. That is a physical, gut-dropping, can't sleep at night feeling. And the data is brutal. Most everyday investors panic and sell right at the bottom. They lock in their losses permanently and buy back in after the recovery, at higher prices. They destroyed the one thing that makes index funds work: staying in the market through the bad years. Volatility isn't a theoretical risk. It's a psychological test, and most people fail it in real time, when the stakes are real and the losses feel permanent. Both strategies have a fatal flaw. And in both cases, the flaw is not the investment. It's the investor. The flaw is not the investment. It's the investor. It's always been the investor. So which one wins? After 20 years. After every number. Every repair. Every market crash. Every 11 p.m. phone call from a tenant. Every month of watching an account drop 30%. Which one actually wins? Here is the honest answer that nobody on either side wants to give you. It depends entirely on you, not on the market, not on interest rates, not on your city or your zip code or the economy. On you. Real estate wins when you treat it like a serious business, when you screen tenants carefully, when you budget for repairs before they happen, when you keep a capital expenditure reserve, when you study your local market, when you manage it professionally and treat every decision like a business owner, not a side hustler hoping for passive income. Index funds win when you have the emotional discipline to leave them alone during a crash, when you can watch your account drop $40,000 in a month and not sell, when you're willing to be boring for 20 years and trust that the math which has always worked over long periods in American history will work for you too. Most people fail at both of these things. They want real estate to be passive. It is not passive. They want the stock market to be steady. It is not steady. The wrong choice isn't real estate. The wrong choice isn't index funds. The wrong choice is picking either one based on a YouTube video, a podcast episode, or what your uncle said while holding a burger at a 4th of July barbecue without ever sitting down and doing the real, complete, uncomfortable math for your specific situation. That uncle might be right, but he's probably also leaving out the repairs, the vacancies, the market crashes, the weekends, and about 15 other things that don't fit on a bumper sticker. Your uncle might be right. He's also probably leaving out the repairs, the vacancies, and 15 other things that don't fit on a bumper sticker. Here's what I want you to walk away with. Ryan and Marcus both started at the same place. Same age, same savings, same American dream of building something real. 20 years later, they both got there. Different roads, different stress levels, different amounts of their weekends spent, but roughly the same destination. The thing that separated them wasn't which investment was better. It was which investment matched who they actually were. Ryan needed something tangible, something he could see, drive past, point to, something that rewarded action and hustle and being hands-on. Real estate gave him that. Marcus needed something he could trust to grow without him, something that didn't require a second job, something that would compound while he focused on the rest of his life. Index funds gave him that. Neither of them was wrong, but both of them got lucky because the investment they chose happened to match their personality, their discipline, and their life situation. Most people don't get lucky that way. Most people choose based on what sounds impressive at a dinner party or what their most successful looking friend is doing without ever asking whether it actually fits them. You now have the full picture, not the thumbnail version, not the barbecue version, the real version with the repairs, the crashes, the compounding, the leverage, the hours, and the 20-year math that most people never actually run. So I want to ask you one question before you close this video. Not which investment is better. Which investor are you? Because that and only that is the answer that actually matters. Not which investment is better. Which investor are you? That's the only answer that actually matters.